Hello students, I'm Vipul Mittal, and in this session I will discuss fundamental qualitative characteristics as specified in conceptual framework. You guys know that the objective of general purpose financial reporting is to provide financial information that is useful to investors, lenders, and creditors, useful in making decisions about providing resources to the entity. Now, the objective of financial reporting is to provide useful financial information. Now, when do you consider financial information to be useful? When do you say that financial information is useful to investors, lenders, and creditors? If financial information is to be useful, it must be relevant and faithfully represents what it intends to represent. So, two characteristics, relevance and faithful representation. These qualitative characteristics are needed that you may say that financial information is useful. These are fundamental qualitative characteristics because these characteristics make the financial information useful. If the financial information is not relevant or not faithfully represents what it intends to represent, then financial information is not useful. So financial information should have these two fundamental qualitative characteristics, relevance and faithful representation. Now, when do you say that financial information is relevant? Financial information is relevant when it can make a difference in the decision of the user. Financial information is capable enough to make a difference in the decision made by the user. Financial information has an impact on users' decision. And when do you say that financial information can make a difference in the decision of the user? When it has predictive value or confirmatory value or both. Then you say that information is relevant. So if financial information has predictive value or confirmatory value or both. So financial information has predictive value when it can be used in the process of predicting future outcomes. Can this financial information be used to predict future outcomes? I give an example. For example, current year, that is year 7. This is current year and revenue figure for this year is, let's say, is $1 million. Can this be used in the process of predicting future revenues? You want to predict year 8 revenues. So you use year 7 revenue figure to predict year 8. So you are also using year 6, year 5 revenue figures. And these are, let's say, $825,000 for year 5 and $910,000 for year 6. So these are the revenue figures for year 5, 6, 7. And you're using this to predict year 8 revenues. So you analyze these figures and you predict revenue for year 8. You say that revenue is increasing by 10%, approximately 10% every year. So year 8 revenue should be $1.1 million. Now the question is that, is the revenue figure for year 7 relevant? Yes, because it has predictive value, because it is used in the process of predicting future outcomes, because it is used in the process of predicting future revenues. Now, financial information is relevant when it has confirmatory value. That is, it provides feedback about earlier evaluations. For example, year 8 actual revenue are $1.09 million. Now, is this relevant? Yes, it is relevant if it has confirmatory value. Can it really confirm your earlier evaluation, earlier analysis? Earlier, you had analyzed revenue figures for year 5, 6, 7 and predicted year 8 revenues of $1.1 billion. Now you know actual revenues. Actual revenues are $1.09 million. Is this financial information relevant? Answer is yes, because it has confirmatory value. It is providing you feedback on your earlier analysis. That yes, your earlier analysis where you predicted $1.1 million as revenue for year 8 is correct or incorrect. So in this case, your actual revenues are $1.09 million. Basis this, you can say that yes, my earlier evaluation where I predicted $1.1 million, yes, my earlier evaluation was correct. So I'm comparing actual revenues with my predicted revenue for year 8 and commenting on my analysis. Yes, my analysis was correct or my analysis was incorrect. So for suppose if actual revenue was not $1.09 million but was, let's say, $1.80 million. This is not the actual revenue. Let's say. Now again, this figure, this information is providing a feedback that my earlier evaluation was incorrect, where I predicted year 8 revenue of only $1.1 million because my actual revenue is much higher. And this actual revenue figure is providing me feedback on my earlier evaluation, that my earlier evaluation was incorrect. I'm comparing this figure with the predicted figure. So this revenue figure for year 8 is relevant because it has a confirmatory value. All right. So financial information is relevant if it has predictive value or confirmatory value or both predictive value and confirmatory value. Now, another important aspect of usefulness is faithful representation. When do you say that financial information faithfully represents what it intends to represent? When representation is complete, when representation is neutral, and representation is free from error. So when do you say that representation is faithful? When representation is complete, when representation is neutral, representation is free from error. So representation is complete. For example, information is provided for a group of assets. Now, information is provided for a group of assets, and the question is that whether information provided for a group of assets is complete. Yes, it is complete if it provides all information necessary. All the necessary information is provided. For example, you provide description of the assets, that this group includes all these assets. You provide a value of all the assets in the group. What this value represents, whether this value is cost or adjusted cost or fair value. So you provide all the information necessary for a user. When you provide all the information necessary for a user, you say that representation is complete. Now, representation should be neutral. That is without bias. That is, you are not emphasizing some information or de-emphasizing some information or manipulating some information in order to make some information favorable or unfavorable. For example, suppose all the assets of the entity are collateralized. You have taken loan against all the assets, but you are de-emphasizing this information. You are hiding this information. You are providing this information in a manner that user does not understand this. You are manipulating. Representation is not neutral. Representation is not without bias. Representation should be free from error. It is not that representation should be perfectly accurate, but the process that is used to produce the information is without error. So the process used to produce the information is selected and applied without error. Is the selection of process correct? Have you applied the process properly? So basically, we are talking about selection of process and application. Both are without error. For example, so you want to calculate the fair value, whether you have used the right method to calculate fair value, whether you have used the right method to calculate depreciation, whether impairment loss is properly calculated. So students, if financial information is to be useful, it must be relevant and faithfully represents what it intends to represent. And when do you say that financial information is relevant? When it has predictive value or confirmatory value or both. When do you say that financial information faithfully represents what it intends to represent? When it is complete, when the representation is neutral, and when the representation is free from error. All right, students. For more such informative videos, please visit our YouTube channel. You find more such videos. So stay connected. Goodbye.